Hello, welcome everyone to our webinar on the UAE corporate tax. And welcome to the world of taxes. As you know, recently Ministry of Finance has made an announcement wherein they have said that the UAE corporate tax will come into picture from next year, from June 2023. So this session is towards taking us through what is the announcement been made so far. So let's get on to it. As we all know that taxes is somebody nobody likes, but taxes is something which is good for a country in terms of increasing the transparency, confidence, even the international impression of the country improves when the taxes are there in the country. And we also know that with the taxes, the government has more money to spend and increase the employment structure in the country. So even if you look at, and when the VAT was introduced long time back in UAE, the initial thoughts of people were that, VAT will make the businesses difficult to do and things of that nature. However, here we are today, the business has actually grown, the economy has done better. We have COVID in between still. The country came out of it, and there is still a lot of new companies coming into the country. So we should look at corporate tax as a positive for overall structure of the country. Okay, so I'll get a little bit about introduction about Premier Brains. Premier Brains was established way back 10 years. So I am one of the partner who was at the very beginning of when this company started. So we have offices in Dubai, Abu Dhabi, at the moment in UAE, and internationally we have offices in Kuwait, Bahrain, and Oman. What do? We are auditors, so we do external audit, internal audit, due diligence audits of those natures. We are tax advisor, tax agent with FTA, very much active on the taxes in the Oman, the other countries as well. And what makes us stand out in principle, and one line if I say, is we believe in always doing the right thing. So this is what makes us stand out, and we want to become a global organization. This is our vision. So a little bit about the speakers today. So we are going to have 3 speakers. One of the speakers is me. So I will be talking a little bit about the overall structure of the tax. And then, so my background is I'm a chartered accountant. I've done my MBA a long time back. Overall, 18 years of experience. Previously worked with Ernst & Young, Deloitte, private equity firm, and with Premier Brains since last 10 years. And then we will have Bhavna, who is also our partner. She's a tax partner. She's also a chartered accountant, experience similar to me, like 18 years. All her career been into taxes. She worked with Ernst & Young, 𝐂𝐨𝐫𝐩𝐿 for a long time before being part of Premier Brains. She's also nearly 10 years with the firm. And then we will have Jinesh. Jinesh is also a chartered accountant. He has 7 years of experience, specifically in the taxes, being into VAT since it was introduced in UAE. So very much aware of what's happening on the corporate tax or on the VAT sphere. So these are going to be the 3 speakers. So I'll just get into the session with a brief introduction on certain topics. So this introduction, I've nearly done it. So let's get into the next set of slides. So we know there are 2 types of taxes. I'm sure most of us know about it, but just to give a good introduction, I will touch upon it. So we have direct taxes and indirect taxes. Indirect taxes are those which are not directly levied. For example, VAT, when we go and buy say grocery item, we don't know, and we also don't have a choice whether to pay or not to pay particular tax like VAT. So VAT is like an indirect tax which is built into the goods and services. And then we have direct taxes, which is actually on your income, on the revenue which you generate, or on the profitability, you can say. So there are different types of taxes which are there in practice. So right now, so far in UAE, we only have indirect taxes, and this is the first time we are going to have a direct tax in UAE. So as I briefly mentioned earlier, so indirect taxes are like in UAE, we have excise tax, custom duty, VAT. These are the indirect taxes which we already have in UAE. And there are certain direct taxes like corporate tax, income tax, wealth tax. So now we are going to have introduction of corporate tax, but I'd like to just say it right now, there is no plan of income tax in UAE. This has also been mentioned in one of the slides from Ministry of Finance. So please don't consider that these are the taxes going to come. No, so we only have taxes, corporate tax in UAE, but this is just an overall look of what all things can be indirect taxes. Yeah. So corporate taxes, as I mentioned, is a direct tax which is paid on the profitability of the company, and this tax is actually paid directly to the government after deducting certain expenses. If I want to show you an image how it looks like, so we have revenue or your sale. So whenever you have sale of goods and services or you have revenue, you have one that there. Then you reduce all the expenses of like your rent, salary, and those kind of natures. And then you come to a taxable profit. So your accounting profit is what on which the corporate tax applies. So there are certain, there can be more clarifications in terms of what is allowed, what is not allowed. Things like, if there is a depreciation on assets, so how it's gonna work on the interest, how it's gonna work. So there are a lot of things which will come later when the law is applied. But we want to say is that it's an accounting profit, but not exactly the same profit which you will see in your P&L. So there will be certain adjustment. I think Jinesh will take that up later on. So this is just to give you a snapshot of how it will look like. So this ends my session, and I'll hand over the webinar to Bhavna to take it over from here. Thank you.
Hi, good afternoon, everyone. Thank you, Rishi, for the background on corporate tax differences between direct and indirect taxes. So, this is a question which would be coming to mind in all of us, that why is UAE introducing corporate tax? So, what is the reason that UAE is considering introducing a corporate tax? So, UAE always want to consolidate its position as a global financial center and an investment hub. Rishi, can you move to the next slide, please? So they want to consolidate their position and increase the tax transparency and show their commitments towards preventing the harmful tax practices. So sometime in July 2021, UAE had confirmed its support to the OECD BEPS project for global minimum tax. So we are going to briefly touch upon what is BEPS, what is base erosion and profit shifting project, what was the main points in the pillar 2. So UAE wants to show its commitment towards global tax transparency and attract investments into the country on a transparent basis. So this is one of the reasons why UAE is introducing corporate tax. And UAE is not the first country in the GCC region to introduce corporate tax. Next slide, please. Yeah, so as you can see here, a brief snapshot of various kind of taxes existing in GCC countries. So UAE has just now introduced the 9% corporate tax, whereas KSA, Oman, Qatar, Kuwait already have corporate taxes within the range of 10 to 20%. Bahrain is the only GCC country which has not yet implemented corporate tax. And in terms of VAT, all Qatar and Kuwait have not yet implemented, whereas UAE, KSA, Oman, Bahrain have the VAT rates ranging from 5% to 15%, with highest in KSA as the 15% and even 20% for the corporate tax in KSA. So let's now go into more detail about what is this BEPS project and what was the need of introducing this BEPS project. Next slide, please. So how has the landscape been so far? It started somewhere in 2016 when the OECD, Organization of Economic Cooperation and Development, and the G20 countries, established an inclusive framework for base erosion and profit shifting. Then came into 2020, where OECD released blueprints for two approaches, which is Pillar 1 and Pillar 2. I'm going to briefly touch upon what is Pillar 1 and Pillar 2. Then, last year we saw lots of developments when in June, they kind of, agreed for a global minimum tax of 15%. July 21, even UAE made an official announcement that UAE is showing full support towards the global minimum tax. And then October and December, OECD came up with further implementation plans about the rules for this global minimum tax. In fact, between 16 to 2020, you would have seen in UAE other regulations coming into picture, like the economic substance regulations, country by country reporting. All of these were the result of the action plans of the base erosion and profit shifting project of the OECD. Next slide, please. So what is BEPS? So BEPS stands for base erosion and profit shifting. So basically the idea of this project was, to avoid eroding the tax base of higher tax jurisdictions. So what used to happen, what happens in the case of multinational enterprises is, because of their corporate tax planning strategy, sometimes they shift the profits from a higher tax jurisdictions to lower tax jurisdictions. And there was a survey done by OECD in 2015, where such profit shifting of the taxes to low or no tax jurisdictions were resulting in a loss of revenue to the governments between 5 to 10% of the global corporate income tax. So this was the reason why OECD came up with a 15 points action plan and started this base erosion and profit shifting project to target those multinational enterprises and to address these challenges of erosion of the tax base due to the shifting of the profits. So one of the action plans we saw resulted into ESR back in 2019, which is already in compliance in UAE since the past 2 years. Next slide, please. So when we talked about, the UAE's commitment to the global minimum tax of 15%, so this was the result of the BEPS 2.0 project. So what was the BEPS 2.0 project? Was basically, to address the challenges of digitalization of the economy. As we know, like in the past few years, everything is digitalized. Whether you can see a lot of e-commerce companies coming into the picture in, for goods and services. And because of this, the companies are domiciled in one jurisdiction where there are earning revenue in other jurisdictions. So it was becoming difficult for the tax authorities to, bring those revenues under their tax base. So there have been, few other levies like e-commerce tax levies done in few of the jurisdictions. And further to address these challenges, OECD came up with a 2-pillar solution. So wherein they have a pillar 1 and a pillar 2. So pillar 1 was basically about profit reallocation as to determining who will have the taxing rights, which jurisdiction will have the taxing rights. And the pillar 2 was about the global minimum tax, which is basically our main focus, which was the reason for UAE also to bringing the corporate tax into the picture. So what does this global minimum tax involves, and what changes because of the global minimum tax? Around 135 countries have already shown their support to the global minimum tax, the pillar 2 solution of the OECD. Let's briefly touch upon, what is this global minimum tax, or what are it's called as the GloBE rules. Just very briefly on that. Next slide, please. So the pillar 2 includes GloBE rules, which are basically global anti-base erosion rules. So what is the main crux of these rules is that to ensure that the multinational enterprises, large multinational enterprises, so they have a threshold of which are the entities which are considered to be covered under the GloBE rules. So these large multinational groups are those groups which have a consolidated annual revenue of 750 million euros and above. So if multinational groups have a consolidated revenue of this, they will be covered under the GloBE rules. So even if you look at the basic key principles which have been released by UAE till now for the corporate tax, even though they have kept the corporate tax at 9%, but they have mentioned in the initial FAQs that there will be special tax rates for large multinational enterprises, which we expect that should be in line with the global minimum tax rate of 15%. But let's see when the actual legislations and the regulations come into the picture. So what happens in GloBE rules is that there is a separate calculation criteria as to how to determine the income. But mainly what happens is if the ETR, the effective tax rate in any jurisdiction is below the minimum rate of the 15%, then there will be a top-up tax which will need to be paid on the profits arising in these jurisdictions. So, if UAE did not introduce any corporate tax, and because there was no taxes, and if such multinational enterprises came into that effective tax rate of below the minimum rate, then those would have paid the top-up tax in the other countries on the revenues which are generated in UAE. So why will any country, want to share the taxes which the companies have generated in their country with the jurisdictions of the ultimate parent entities? So that was also one of the reasons for UAE to bring this corporate tax into the picture. So it is currently kept at a very lowest level of 9% if you look at across the GCC tax rates. So I hope this has given you a brief background about what led to all of these corporate tax coming into the picture, and what are the basic background about introduction of corporate tax in UAE. Next slide, please. Yeah, so this ends, my slides on the background about UAE introducing corporate tax. So now, Jinesh, I'll hand over to Jinesh, who will be covering about, the basic principles which have been announced till now about the UAE corporate tax. So handing over to you, Jinesh, now.
Good evening, good afternoon, everyone, and thank you, Bhavna, for this brilliant session. So it helps us set a base as to why UAE is introducing this corporate tax at this stage. While we wait for the laws and regulations to be out, there are certain FAQs which are updated on the MOF website, which gives us a broader idea as to what would be covered under the corporate tax. So I will be going through the highlights. So can we move on to the next slide, please? So basically, the primary question is who will be covered under this scope? So all businesses conducting commercial activities will be covered under the scope of the corporate taxes, including freelance licensees will be covered under the scope. Another interesting aspect that is covered under the FAQ so far is that, what we have seen in case of VAT, companies, group companies will be allowed to form a tax group. So they can submit one single return, a combined return for all the revenues of the group company. The third is on what will be these taxes applicable on. So the taxes will be applicable on your accounting net profit. So there will be certain adjustments or deductions, so to speak, and allowances which will be specified, and we'll have more clear idea about those once the regulations come out. So basically, your accounting net profit will be subject to the corporate taxes. So while we talk about the profits, we will need to look at the other side in case of losses. Such losses will be allowed to set off against the profit, and also there will be certain rules for carry forwarding these losses of one financial year to the next one. So we will have to wait for the regulations to come out to have more detail on this. Another interesting aspect is group relief provisions. So whereby losses of one group entity can be set off against the profit of another group entity, which will help manage the tax burden on group entities based out of UAE. Can we move on to the next slide, please? So the tax slabs, another important aspects. So, so the taxable income, what we discussed earlier, up to 375,000 will be subject to a zero rated tax, and anything over and above 375,000 will be subject to a 9% tax rate. There are special rates for multinationals with consolidated group revenues of about 750 million euros. That translates to about roughly more than 3 billion AED terms. If you look at the rates of taxation in the UAE, these are quite competitive, not just under GCC countries, but also throughout the globe. It is the lowest in GCC countries. Saudi has a tax rate of about 20%. Kuwait has 15%. So it's quite competitive. So it helps solidify UAE's position as a global investment hub. Can we move on to the next slide, please? So we'll go through one basic example here of how the corporate tax will be calculated. So we have our total revenues. Then we have our cost of goods sold, which gives us our gross profit. And then we have our other indirect expenses. And then we arrive at a net profit, which will be offered for taxes. So here in this example, we have 400,000. So up to the first slab, so up to profits of 375,000, there will be zero rated taxes. And anything above 375,000, so the 25,000 will be subject to a 9% tax. So the total tax liability comes out to 2250. So the effective tax rate is quite on the lower side because of the tax slabs. The laws and so once the laws and the regulations are out, we will have more idea about the allowances and the deductions. So these are usually in terms of interest, cost allowances and depreciation rates, which will be offered for the tax purposes. So what we see in the EU jurisdictions is that there is a cap of 30%, say for example, on interest. So the 30% of your EBITDA is the cap for interest expense allowances. So we'll have on similar lines, there are depreciation rates specified under different jurisdictions. So we'll have to wait for the regulations to help us with more information on these allowances. Let us move on to the next slide, please. So what is the effective date? So when will this come into picture? So basically, the MOF has specified that the effective financial years will be financial years beginning on or after June 1, 2023. So unlike other jurisdictions where we have a fixed financial year, so far there is no fixed financial year specified, a tax financial year specified under the UAE legislation. So we will have to wait for more information on that. But there is a certain illustration based on the above announcement to help us understand the effective years. So say, for example, your financial year is June 1 and ends on May 31. So June 1, then the effective date of taxation would be June 1, 23. Now, most of the companies in UAE follow a calendar year as their financial year. So for them, the effective date of taxation would be January 2024. So which gives enough time for companies to prepare and align their systems, peoples, and processes with in line with the UAE corporate tax regime. Can we move on to the next slide, please? So talking about certain exemption, so there are certain relief provisions. So one of the most important aspect, which is clarified and covered by the previous speaker as well, that individual income will not be subject to taxes. So income earned by individual from their salaries and their investment into bank FDs and saving certificates will be outside the scope of the corporate tax. So that is a huge sigh of relief for individuals. So this helps us clarify that as of now, there are no plans of introducing a personal income tax. There are certain dividends and capital gains by the UAE businesses from their qualifying shareholdings will again be outside the scope. We'll have to wait for more details on qualifying shareholdings. And then there are certain intergroup transactions again, which will be out of the scope of the corporate tax. So more details on this will be revealed once the law and the regulation is out. So foreign investors' income from their investments will also be outside the scope of the corporate tax. So these are few of the exemptions that are explicitly listed out right now. We will await for more clarity on these aspects from the law and the executive regulations. Can we move on to the next slide, please? Okay, one of the hottest topic of the town is free zones. So right now, very little information is available on the FAQs. So what we have seen is that free zone entities that follow all the specified rules and regulations, and they do not conduct any business with the mainland UAE, will continue to enjoy certain corporate tax breaks. But that does not mean that they will be outside the purview of the tax departments. They would still need to register and file for their corporate tax returns and retain enough proof to show that they are indeed outside the scope and they are not conducting any activities which would be covered within the scope. So we would wait for more information and clarity on this once the law and regulations are out. So we would have a better idea. So this will be another interesting topics to be covered once the law is out on this. Can we move on to the next slide, please? So there are certain implications for non-residents. So they are given certain benefits, as in terms of individuals and foreign entities, unless they do business or conduct any trade in the UAE, they will again be outside the scope of corporate taxes in the UAE. And as mentioned earlier, certain investment incomes in terms of dividends and capital gains and royalties for non-residents will also be outside the scope of the corporate tax in UAE. So we would have more clarity once the regulations are out on this. Then in terms of withholding taxes, what we have seen in other jurisdictions, so there are no requirements for withholding taxes on cross-border payments in UAE. So this helps ease the burden of compliance on the UAE businesses. So this is another sigh of relief for businesses in the UAE. Transfer pricing. Transfer pricing basically will be a very broad area, and we are expecting a separate set of legislation income on this. So transfer pricing basically helps set parameters for pricing of transaction between intergroup companies. As we have seen in UAE, in case of multinational entities, there are multitude of transactions that would be happening between entities which are based out of UAE and based within UAE. There are multiple companies. So the pricing lines should for third party and intergroup transaction should be at arm's length principle. So basically businesses would need to reevaluate their current arrangements in terms of their intergroup pricing to align them with the arm's length principle. So basically the OECD guidelines would be the focus point for corporate tax in the UAE to connect them and help businesses align their processes. So this would entail again additional compliances for businesses in UAE to in terms of maintaining their local file and master file, as we have seen in case of other jurisdictions. So this will be another interesting area which will be covered by the regulation, a very broad one at that, what we have seen in case of other jurisdiction. So we will wait for more information on this as well. Can we move on to the next slide, please? So now comes the compliance obligation. So there will be only one annual return which will need to be filed on the FTA portal. So the registration for corporate tax for businesses would need to be done on the FTA portal, and there is just one annual corporate tax return. There are no withholding taxes payment or advance tax payment to be made at this stage, is what we know. Can we move on to the next slide, please? And of course, there are penalties for non-compliances, what we have seen earlier as well for other taxes. So speaking about authorities that will be governing the corporate tax regime. So at top, we have the Ministry of Finance, which is the competent authority for the purposes of bilateral and multilateral arrangements. And the FTA will be responsible for collection and administration and enforcement of this thing. And FTA is quite familiar now since VAT is introduced in 2018. So the taxpayers are also familiar with how the FTA operates and governs the tax regimes in UAE. So, so there is a great sense of familiarity in that sense as well. So moving on to the next slide. So these are my slides. I would hand the presentation over to Rishi to show us the way forward.
Thanks, Jinesh, for the wonderful session. I think in few slides you have taken us through the ride. It sounds so simple as you have very nicely done it, but there are a lot of things in it which we need to be aware. So this session, I'm going to discuss very broadly from the view of the company as to how should they approach from here on. Like if we go back to the time when the VAT was introduced, there was a lot of nervousness in terms of how it will function and all, but I think the corporates have really adjusted very well, got good systems in place. There are few here and there weaknesses, but overall the companies have really adjusted. So now how that adjustment will happen in the corporate tax environment is something to look forward. So let's just see what as a company should do. So I have very broadly split this into 4 portions. So first is now we stand today, what do we do now? So basically when we know today that the corporate tax is going to come next year, so what are our action points? So some of the things which out of experience I like to say in the taxation world is that things cannot change immediately. For example, the tax authorities are very well aware how companies operate. They have the information, they have the data from the VAT side. Plus, they also know you have got audits in the past, you have submitted audited financials, you have the history with you. So what is important at this stage is to first of all sit back and understand how the company is functioning, what is the impact on the company in terms of this tax. So tax impact is not only the 9% which is going to be paid to the tax authority on the net profit, but the impact is also in terms of how is your documentation and processes are in place. In the VAT, there are a lot of changes already been done, but again, the focus of the VAT was always, you have the output VAT which you charge to your customer, and you have input VAT which you pay to your supplier. So this is what was the main area of compliance. The companies have really done their accounting system in good shape. But now with the corporate tax in place, all your expenses, so you have expenses of nature of, charges between your intercompanies, then you have freelancer providing services, you have salaries paid out, you have managing directors withdrawing amounts as salary or as dividend, and you have assets which are depreciated, some are expensed, some are not expensed, some are capitalized. So these all were not an important factor in terms of VAT. But with the corporate tax coming into picture, now your whole income statement or your P&L actually become an area to look into, because what will happen is as Jinesh mentioned, that the tax is on the accounting profit, but there will be certain adjustments on that profit, because some of the expenses which you want to claim might not be allowed in the tax law. And so some of the expenses which you can claim, which you might not be doing it right now. So there can be certain areas of that nature. So at this stage, what the company should do is, first of all, sit down and look at their past performance, at least for last 2, 3, 4 years, see how it is looking for 2021. If they are already done audit, well and good. If not done audit, just go back to the table and see if there is anything they need to look into from a corporate tax point of view. And then in future, how that impact is going to flow. So these are important things. The restructuring should happen from there. So for example, if a company goes on, say, 31st of May 2023 and say from tomorrow I will do the changes, it's not that straightforward. So there is every chance that the tax authority would like to see how the company has been doing since past, and is there a sudden change for tax planning or not. So there has to be a genuine reasons for any changes. So it's very important, the earlier you start, the better it is. So first stage is basically do a high level review of your system. So we have taxes in Saudi, Qatar, Oman, and for example, in Premier Brains, we are aware about what the rules are. So what happens is, at least do some research in terms of what are those practices, how that can, some of those practices can be absorbed. So that's point number one. Then secondly is, once the tax law is out, which we don't know right now, but it will come out in coming months. That is the time we actually then to do a deep dive and do any changes. So first thing is, today is like, if you have not done already audit of 2021, you should look at from a corporate tax point of view. First thing. Secondly, once the law comes into the picture, immediately look at all the major provision which you can take place. What will happen at that point of time, to be honest with experience, is that once the law is out, all the tax expert or the people in the organization, they get busy with a lot of queries all around the place. So what happens is, the finer points which needs to be looked at that point of time gets missed. So many times I've seen from experience that some of the points, from a VAT angle, which could have very well structured properly before the VAT came into the picture, took 6 months after the VAT already in place that the company has started to look into it, and they are losing some of the tax elements because of that. So there are, it might sound like, why do I do? I mean, we have enough time, but what happens, the time passes very fast. And the law always evolve very fast. Like till today in VAT, we continue to see changes. Every month there is a new guidance, or there is a new circular coming. I mean, as tax expert, we know what's happening all the time, but as a company, it's very difficult to follow it, because there are different elements already in the business to look after. So it's very important, the earlier you start, the better it is. Then thirdly is the implementing. So before the date of corporate tax, it's very important that your systems are actually ready to take up the corporate tax. So the accounting, like for example, why I'm saying this is important is, so the accounting profit which will show in your, say, system might not exactly be the profit which will apply for corporate tax. So there can be certain adjustment, because there will be regulation around. So as Jinesh and Bhavna mentioned earlier, that we have this transfer pricing issue. So intercompany, normally now we invoice each other, if part of a VAT group, doesn't matter. But if it is out of the group, then there is no as such a restriction on what pricing is done. But with the transfer pricing in place, this will be monitored, right? So all that things should be, those kind of adjustments are expected to come in your income statement. So how your system is going to run that? So just, it's not like a dump from the system and you go and file it. Same in the VAT, what happened was that the software companies, they came up in the VAT return, the format was prepared, and most of the company actually are still following the dump from the system and post it on the ledger. But what happened is there are certain things which actually could not be claimed, or things of that nature were not been considered. Only when the VAT deregistration come to picture, when the audit happens, things start to haunt. So what happened is when this corporate tax is implemented, it's very important that how you're gonna monitor those adjustments from the income side. It should not be happening that the person or the accountant of the company just take the P&L and do the filing. The adjustment should be looked at. What happened is the tax authority will not immediately question, because it is a self-assessment at the end. So you are filing on a self-assessment basis on a regular basis. But later when the tax audit is done and they find out something, they are going to blame the company only, because ignorance of law is no excuse at the end. So it's important that at the implementation stage, you have right structures in place, how the calculations are being done. Then the last is the operating post-implementation. So this is an ongoing process. Jinesh mentioned that the returns will be filed on an annual basis, and there is no advanced corporate tax at the moment, which is good. So important point in this is obviously your cash flow management. There should be a way to keep your tax stored in a separate location, because sometimes the company is profitable, high profitable, then but the cash is not always in the hand, because that is in the business, running in the business, generating more cash flow. So at the end of the tax period, there should be enough planning in order to pay those taxes. In the VAT, is still better that quarterly you have tax, but it is lower amount, easy to manage with the but the annual thing can become a little bit of a stress. So cash flow planning is important, and then regular review of the accruing tax is important from a management decision making point of view. So going to the next slide. So there are three main considerations. Any system in a corporate tax world is involved three things: technology, process, and the biggest one is people. The people is the power, I would say, because if you have the right information, right people sitting with you, it will be an easy go. But if the people are not educated or not trained, what will happen is the filing will still happen. They will do the technology, do the filing. They will do the process, do the filing. For example, if the return is say on like tomorrow, they will do the filing tomorrow. But not, the thing is, garbage in, garbage out is the problem. So right people and people trained is very, very important. So you have accountants in your company or your senior people. It's always better to have them take active participation in getting trained. Just because of plain reading of things on the Google is not good enough. Going into the practical aspects of it is very, very important. So I highly recommend that, encourage your people to be more active in terms of learning about it. And I also recommend that the managing director or the owners of the company should also put an extra effort in understanding what are the high level points. Because sometimes things get missed in the process. So not having a knowledge of the overall tax is very important. And UAE has always been keeping tax law very simple. So it's not going to be a very, very complex thing. So keeping an eye on the high level points is easy to do. So I would recommend at least the high level points should be considered. So another few slides I'd like to touch upon are these. Action, sorry. So this is the last slide. Okay. So restructure existing tax, not tax, I would say the financial from a tax efficiency point of view. Why I'm saying this is, like, for example, you have certain freelancers who are paid. Now the question is freelance is going to be allowable expense or not allowable expense? Then depreciation, maybe your building is depreciated over 20 years. So you have a lower depreciation expense, but is it going to be the same with the tax authority or no? Then staff salary. So staff salary is paid, but what about the salary of the general manager or the managing director or the partner of the company who is on a different visa? So is it going to be, you can put any salary, or there has to be certain limits or not? Need attention to that. Right now, maybe in the past year, a lot of companies may not have their owners taking any salaries. So if they suddenly start taking salary, is it okay? I mean, with the tax authority will get a little bit confused with that, or what? So need to think about it. Do that right now. At least you have some history. So if you're going to do it like tomorrow, the tax is coming to picture and you do today, it's not good enough. There has to have a history in order to justify it. So like Jinesh mentioned about the transfer pricing rules in the OECD guidelines, not very difficult. If you do a little bit of research, it is easy to find. More or less in the bottom line, it's about arm's length transaction. It should be reasonable pricing, which is there in the market. Across the market should not be abnormally high or low. This is more or less how the transfer pricing works. But there are some fine points in it, to better spend some time understanding this. Review existing financial records and control. As I said, in the VAT, we were only focusing on the output VAT, input VAT. But there are a lot of other expenses in the company, which not necessarily have VAT. You have salary expenses, you have freelancers in the company, you have certain other kinds of expenses, possibly if you go into the books, right? So now the thing is, even like, for example, cost of sale, like in the case of VAT, when you purchase any goods, you pay a VAT, input VAT to your supplier, but this goods may not be immediately sold. So it sits in the inventory and you sell as and when the order comes. So what happens? The cost which gets booked into your income statement is not the entire purchase which you do. It's whatever you sell, the cost relevant to that sale gets booked. So what pricing is that going into the books, or what's the impact? So these are the factors need to be looked at. So VAT, it was good to have it, but that's not good enough from a corporate tax point of view. There need to be a little bit of more thought process going into it. Review the existing IT infrastructure is going to be very, very important, as the filings are online. And many companies even today are not still following system. They are relying on Excel sheets. So immediately stop Excel. That I can definitely say. It was never a recommended practice. Even from a VAT point of view, it's not good to have. Always use a system. There are a lot of system which is available online, offline at very reasonable prices. Take a moment and take those on. It really helps in the long run. Document management process. So update all the system of how the accounting is going to work, how the finalization will work. At least have, if not a very lengthy document, at least have some brief flowchart kind of a document to know how you're going to do it, what are the deadlines, how to review it. Because reviewing your financial performance is very important. Don't wait for the last minute, or for example, your auditor comes tomorrow and they tells you a big bill of tax to pay and there's not enough cash. That's not important. It's important when the taxes comes into picture. A successful company always become very active immediately rather than waiting for the last minute. Stakeholders should be put into the discussion immediately as well, because what happened with the stakeholders is they may be not from the finance side of it. The immediate impression is that, oh, taxes there is going to hurt us. So not necessarily all taxes hurt. The taxes actually can create a lot of opportunities. So I would say pay some attention to the bright side of things. And any country which grows bigger and bigger eventually have taxes. But having a 9% tax and 5% VAT is actually a very low value compared to what UAE government has offered to the country. And overall, if you see, the growth of the country over the years has been positive only. Like personally, I'm in the country for like 16 or 17 years. I really see it progressing every month. So bring stakeholder with you on the same page, create that acceptance and readiness to really embrace this tax, which is going to come in some months from now. So with that, I end my slides. I think let's get on the Q&A session. So Bhavna, would you like to volunteer for this, to take up the Q&A questions?
Yeah, sure.
And sorry, we missed to mention earlier. If you have a question, please either you can type it on the chat window, so Bhavna can take up. Thank you.
Yeah. So thank you so much, Rishi and Jinesh, for a wonderful session, and very important next steps being covered, before June 2023 for businesses to start preparing for the corporate tax. So if you have any questions, please feel free to type in the chat box. I have received a few questions which I will take. So there was one question on the financial year. So it was mentioned that the financial year is June 23 to May 24. So the tax will be applicable from June 23. So if the financial year, I think the person wanted to mention if the financial year is from January 23 to December 23. So in this case, the tax will be applicable from January 24. It's not June 24, because what the tax authority has mentioned, that these are applicable for financial year starting on or after 1st June 23. So if your financial year is starting after 1st June 23, so for example, if it is starting 1st January 24, then the effective date of implementation for your company will be 1st January 24. So that's how the effective date of financial year will work. I hope that answers your question. So Rishi, another question which has come up is that will there be requirement to submit annual audited financials?
Audited financial, in my opinion, yes. Audited financial will become a compulsory thing. Right now, most of the free zones are having financial as a compulsory requirement. The audit financial will definitely become a compulsory thing. Very simply, that government also would like to see some transparency and third party involved in assessment. And actually, it is good for the companies, because if a third party looks into it, there are no bias involved. And secondly, they apply the realistic accounts. So the accounting principle applied will be IFRS in UAE. And so, sometimes these gets missed when the finalization happens. So some of the expenses which are not allowed gets allowed. Some of the expenses which are allowed are booked as in the balance sheet item. So audit, definitely, I think it will become compulsory. That's my opinion.
Yeah, anyways, actually, even compulsory as per the commercial companies law of UAE, and so now even the submission will get compulsory in the future. So another question is that what will be the main challenges and benefits for companies with the implementation of the corporate tax?
What will be the main
What will be the
challenges
main challenges and benefits with the implementation of corporate tax?
Challenges, I think I've already discussed that. The major challenges will come in terms of structuring from the point of tax, because as I said, now after the VAT companies know what VAT will be paid, what will be collected. But in terms of income statement, people are still not looking into it from accounting point of view, like the accounting standards point of view. So there will be certain expenses allowed, not allowed, that has to be taken into picture. So that will be one challenge which will be a problem in the initial days. And even like if there are intercompany loans on interest, so what rate of interest will apply, these kind of things, and the transfer pricing rules. Transfer pricing is new to the country, so these will be some of the challenges. The benefit, I would say definitely, is it will improve. It's kind of one of the bases which banks will consider in terms of their rating, one thing. So now company goes and for example borrow monies, they are immediately ask the VAT return. So what will happen in the next time is they are going to ask the corporate tax, because now it's about profitability. VAT may not necessarily mean profit, right? But with the corporate tax, it will actually show whether the company is making profit, and it's good for lending and overall financial point of view. So I think that is going to be a big advantage.
Yeah, as you rightly said, the accounting principles will become even more important to be looked at. How have you recognized the revenue? How have you recognized the cost in the books? That will play a very important role. in terms of the corporate tax. So another question which has come up is that can we change the financial year from June to May to Jan to December?
Financial year change is possible.
Yeah, I think this is like someone wants to have some more time until the corporate tax effective date. So if someone is already having a June to May financial year, they might be looking at changing it. So then they get 6 months more time to prepare for the corporate tax.
And save more money. So yeah, true. So changing the financial year is always going back to your legal documents. If you look at the MOA of your company, memorandum of association, or the legal document, normally the the year end is always defined there. So if you want to change it, you can change it. There nothing stops you, and I don't think there is any problem with that. But what you have to do is, first of all, go to your legal document and make that aligned to that, and then do the change. So that's what I think.
Okay, someone has a question that if the goods are not sold in UAE but payments are received in UAE, what will happen?
Dinesh, you like to say on this?
Yes, sure. So in that case, see, the corporate taxes are usually on the profits of the business. So we will have to understand the correct nature of transaction as to why the goods money is received here. Is it an on behalf payment? Can this be considered as a part of the revenue? So we'll have to understand the exact nature of transaction in this case. But broadly speaking, the tax is on the profits. So if it is a part of the revenue, then we'll have to consider it accordingly. And also the accounting principles as per the IFRSs will also be applicable to treat this transaction in the books accordingly.
Yeah, so as Jinesh rightly said, you have to look at if those sale of goods form part of the revenue. If yes, then yes, that will come into the corporate tax calculation, where you will be deducting the expenses from those revenues and then paying the tax on the net profits. Okay, so I think we are just close to the time. I'll just take one more question which has come up. It's like, other GCC countries have special rates, special rules for local GCC nationals. So is it something similar expected for UAE corporate tax?
So far, my reading, I have not seen anything specific about this, and doesn't appear to be so.
Yeah, so currently, there is no information. It's a very relevant question. So there is no information announced by the ministry on that front. So we'll have to see the actual legislation and the regulations to see how the UAE authorities approach this particular point. So I think it's 1:30 now. So we will end this session. There are a few more questions which we will directly, get back to the person who has asked the question. So thank you so much, everyone, for taking out the time for today's session. Hope you had some good insights into the initial policy principles of corporate tax.
Right. And just when you end, I'd like to say, if you have any specific thing or you missed to ask it now, please drop an email to info@premier-brains.com. And we'll happy to guide whatever we know as of now. Yeah, that's it.
Thank you so much.
So I'll end the session for today. Thank you for joining. Have a wonderful day.
Thank you.